Hello, good morning. My name is Andrea Williams, Senior Assistant Director at the London Property Alliance, and I'll be moderating today's webinar, which will offer some expert insight into the central market London landscape. We'll be focusing on how London's economy is performing in relation to other global cities, the West End and city office markets, and central London's residential market. Discussing this, we have London Property Alliance Chief Economic Advisor, Alexander Jan, Chris Valentine, Head of Central London Office Agency, JLL, Dan Gaunt, Partner and Co-Head of London Office Leasing and CPA Board, and Katy Warrick, Head of London Residential Research at Savills. Alexander will be kicking off with a presentation on London's economy, but before I hand over, I would just like to remind viewers that after the panel, we have plenty of time for Q&As using the Q&A function at the bottom of the screen. So without further ado, I'll hand over to Alexander. Over to you, Alex.
Thanks, Andrea. Thank you very much. Good morning, everybody. Andrea's done the introduction, so I shall say no more about me. What we thought it would be good to do is just sort of canter through an update on an initiative that the LPA has recently launched, which is a global city survey. And we'll also share a few of the results, but not all of them because time is short. You'll see there's a link on the slides which will allow you to find the report and go into it in more detail if you'd like to. So next slide, please, Tim. Okay, so I'm just going to talk about why we've decided to do this survey now, the cities we've selected, some of the measures we've identified, and as I said, a few of the results, and then a few conclusions which can help provide a little bit of context for our discussion after our colleagues have done their excellent presentations on the market. So in summary, it's about 30 years ago since London World City, which was this book, some of you may remember. It's when I started work for my sins, and at the time, London Planning Advisory Committee, so before the days of the GLA and so forth, but after the abolition of the GLC, that work was done because London was shifting from a position of long-term population decline to one of growing populations and employment. We had the famous Big Bang deregulation of financial services in the city. We also had, slightly ironically and sadly, some would say now, given where we are, the advent of the single market a few years later. And we were really seeing globalization take off at scale in terms of investment, movement of people and labor and capital and the expansion of markets and so forth. So that was why I think the different parts of London's government came together to commission that report. And it was really about trying to understand how London should navigate the consequences of growth when its infrastructure in the city were kind of creaking at the seams a little bit. So if we fast forward to 2022, and sometimes I think we mean 2019 by 2022 because of COVID and everything, we've seen a near third increase in London's population, a 40% increase in employment, and I'd say a bigger and more diverse economy. And today, the sort of challenges that we're facing are actually the impact of Brexit, a sort of partial retreat from globalization, you could say. Our public finances are under tremendous stress in terms of borrowing as a proportion of GDP, the highest since 1963. We've got this challenge of how London is perceived and being treated by central government. And of course, there are big challenges around sustainability, housing, and of course, COVID-19. And I think, key driver of the survey is to try and shift the debate around London onto the international stage rather than seeing it as a sort of zero-sum game scrap with other cities in the UK. Because London is really competing, as many of you will, I think, appreciate, on the international stage for talent, investment, visitors, culture, and so forth. And finally, the research that we've done is commissioned by the Centre for London, which is London's leading think tank. Thanks, Tim. The city selection, I'll keep it very short. Paris, our local world city on our doorstep, potentially the most to gain from Brexit, big plans for the Olympics, the orbital railway, the Grand Paris Express that's coming along soon. Berlin, up and coming city, is it, small place, but is it finally going to achieve critical mass? New York, of course, much more in common and closest competitor to London in so many ways, probably the closest city to London in the world in many factors. And then Hong Kong, and despite many of the challenges that are going on there, it's still a major centre of economic activity in the East with global reach. Thank you. Next slide, please. Okay, so these are the 18 indicators that we have included in our report, but the ones in purple are the ones I'm just going to touch on here because I think they're most relevant to the discussion we're having today. But all of these indicators are included in the document. Thanks, Tim. So just to whiz through. So these numbers are typically, the ones we're going to present are typically to the end of Q3 2021. And as you can see, and throughout these charts, London is in black and New York is in that pale blue. And those in some ways are the two I'd ask you to sort of focus on. And as you can see, impact of COVID is very evident on this slide. Q2 2020, London saw a big reduction in its output, but then a strong bounce back in Q3 2020. And actually since then, throughout 21, London has been doing comparatively well in terms of its economic growth. New York State isn't on here because of the timing of their data release, but we know that it grew a little bit in Q3 at the state level. We can't get city level data. So London in overall terms hasn't done too badly. Next slide, please, Tim. Okay, so office vacancy rates. This is a big question that we're going to be coming on to. Again, you can see London in black on this scale. And again, an increase in office vacancy rates in Q2 2021, but actually signs of recovery, you could argue, reduction to around 8% in Q3. But look at New York, these are Manhattan occupancy rates, and they are nearly at 20%. So more than double what central London is seeing on this chart. And Berlin and Paris, much lower, and maybe we can explore some of these things in a second. Okay, next slide, please. Okay, office rent, another obviously very important indicator. And again, what you can see here, we've split out London West End and London City markets, but London West End performing very well in terms of change of office rents for from the CBRE tracker indeed in Q3. And again, New York showing a softening, interestingly, alongside Hong Kong, Berlin continuing to show positive territory in both quarters, which is perhaps a reflection of some of the structural factors in the city in terms of overall demand versus the availability of stock. Thanks, Tim. Next slide. And then coming towards the end now, because I'm conscious of time, but in terms of workplace-related mobility, so this is a measure of how much activity Google is associating with workplace type movement. You can see that Hong Kong has seen actually is ending in positive territory at the end of November in terms of against the pre-COVID benchmark, whereas both London and New York are way down on their pre-COVID benchmarks. And this theme of getting people back into central London, it's actually a Greater London measure, but this whole theme about getting people back into the office, back into our city centres is a challenge which is facing not only London, but these other great world cities too. Thank you, Tim. And then finally, I think, Tim, maybe one more after this, but we thought it'd be good to just show some measure of new homes completed. And in aggregate terms, London is actually doing quite well. But when you divide the number of new homes being completed in any year, and this data only goes to 2020, by the population of cities, you can see that London slips down the league a bit to just 4 properties per 1,000 population. But again, New York is way below Berlin, Hong Kong, and London on this measure. Paris data is virtually impossible to get hold of. But again, a very interesting, I think, piece of analysis which tells, and this is a common challenge for all of these cities in terms of trying to accommodate their population and their working population. Thanks, Tim. Next slide. Okay, so here is just a sort of summary of results where we've grouped. Tim has actually helped here to group and then average out our broader sets of indicators by these themes. And in essence, it kind of shows Hong Kong in a very strong position. London is sort of in a middle zone, and poor old New York is really struggling at a sort of aggregate level when we analyze these cities across these broad groups. Now, that doesn't mean New York isn't going to bounce back. They've just had a big federal grant for transport, $6 billion grant, biggest grant the MTA has ever received. And the new mayor will have ambitions to get the city moving and its economy recovering. But so that's kind of where London is holding at the moment. Next slide, please. And to conclude, London's kind of doing well on a number of these indicators and less so on others. Well, you might say, well, what does that tell us? But Hong Kong is performing surprisingly well. And as I've said, New York is by some distance in lowest position. They only provide a snapshot. We appreciate that. There's limitations to them, but I think they are useful indicators. And for us, in terms of the next survey, which will be coming out later this in spring, I think understanding why cities are performing in the way they are, and then thinking about the policies that can help London to compete with them more effectively is where we'd like to take the next part of our work. And that's all from me, Andrea.
Great, thanks so much, Alex. Chris, over to you.
Great, thanks, Andrea. Can I just confirm you can see my slides? Excellent, thank you. Morning, everyone. Chris Valentine, I'm going to give you a quick overview of the West End, looking back to 21 as, I guess, the scene setter, and then I look forward to 22 and what we hope and forecast to see. So broadly speaking, last year, after a quarter of very limited activity as we started in lockdown, we saw a really quick and robust rebound, taking the full year take up to 3.8 million square foot, which is double 2020 and about 8% ahead of the long-term trend, which is a fantastic result and one that we wouldn't necessarily have expected as we sat this time last year. Looking forward, 1.5 million square feet under offer, which is double the long-term trend, which points to some strong and quick momentum this year, which should set us up for another year of good take-up. Active demand, we did start to see pull in during the course of the back end of last year. We don't see this as a cause for concern. We had a couple of quarters of phenomenal take-up, so we think that's in relation to that. And talking to our tenant rep team and those of our competitor firms, there's lots of tenants who are currently gearing up to get active during the first half of this year. Prime rents, we had stable for Q4, having increased them in Q3. And again, we'll come on to the supply and demand dynamics, but there's a continued focus on the best space. And we think that will drive rental outperformance during the course of this year and beyond. Overall vacancy and new build vacancy sitting above that long-term trend. However, we've now had 3 consecutive quarters of decline in that vacancy rate, which is really encouraging. And as we see that under offer figure start to transact and complete on spaces, and the active demand pool really start to get into their deal zone, and we expect to see further absorption of the vacant space. Particularly with the recent announcements from Boris, more people are going to be back in the office, hopefully, than we've seen for quite some time. And whereas a lot of the availability, 27%, is tenant space, we think that will be reabsorbed as people realise they possibly can't get rid of quite as much space as they thought they might have done earlier in the pandemic. Speculative under construction, 3.8 million square feet, above trend, but actually as we look at the demand, we think this is going to be absorbed quickly and certainly before it reaches completion. And lastly, and very quickly, because this is out of my area of expertise, the investment market, 2.6 billion traded in the last quarter, way ahead of the trend figure and taking the full year to 5.2 billion, which is the best year of performance since 2018 by our stats. And with 2.8 billion under offer as we start the year and some very significant sales being launched, we think the investment market is going to trade well as we head into 22. So just looking at a few of those deals that underpin the activity we've seen, we've tried to get a mix of different sectors here to support the story of West End being a very diverse place. So Ted Baker, obviously a retailer, a quite difficult trading environment during the course of the pandemic, decided to sell their building, the ugly brown building up at King's Cross, take a short-term lease back and then consolidate their staff in a more central location, acquiring the lower ground and ground floor at 101 Cleveland Street, which got great volume, brilliant showroom and office space, and a rent roll, which is about 30% of what they would have paid had they taken an option up at King's Cross. 20 Grosvenor Street, interesting for a couple of reasons. Largest deal that was seen in the core Mayfair and St James's market during the course of 2021. And also Fora, a flex provider, taking a conventional lease, part of the market that has been quite dominant for 5 years pre-pandemic, but really died as, for obvious reasons, their occupancy levels started to fall. Fora, probably the most front-footed of those operators, planning to open 6 centres during the course of 2022. And when you talk to whether it's Fora or their competitors, whilst their occupancy level remains quite low, actually they have now got more committed space than they did pre-pandemic. So we expect that to be a sector that's very active during the course of this year. Facebook has to be discussed. Q3 took just over 500,000 square feet. That's following completions at King's Cross, where they previously pre-let buildings, and also Rathbone Square. As an occupier that still has most of their staff working from home, amazing to see this kind of commitment. And I think it's a great sign for London as that continued gateway for their EMEA expansion plans, but also really good news for the future of the office and how they see it as being fundamental to their continued success as a business. Paddington Square, the largest speculatively delivered building currently under construction. First deal completed in Q4, and the rest of the building, 325,000 square foot under offer, with those deals set to complete this quarter, which not only a huge amount of take up, but setting new rental evidence for Paddington as a sub-market. And then lastly, 78 St James's Street, 110,000 square feet, fabulous building, very generous in the quality and quantity of communal space, and experiencing that early take up, 2 deals done, 1 under offer, and conversations ongoing on the rest of the building. So that's looking back. As we look forward, active demand pool of 3 million square feet, driven by the banking and finance sector. And in the context of the West End, it's those boutique financial houses, your private equity firms and hedge funds that drive the take up. And they tend to trade well in periods of volatility and have done in large part during the course of the last 2 years. So not only are they driven by structural events, they're also expanding headcount and now footprint, as seen by Davidson Kempner on the list on the left, amongst others. That financial sector followed by TMT services, professional services, and probably worth noting that we have no large global tech currently active in the West End, but we know that people like Microsoft are gearing up to come to market and expect them to be big takers of space over the course of this year. Now, I won't go into detail on these tenants, but I think what we can say is underlying a lot of these requirements is a focus on sustainability, connectivity, and a desire to upgrade the amenity offer that they have in the buildings for their staff. And that plays really well to this development pipeline that's coming through over the next few years. Interestingly, 46% of those schemes that are currently under construction are either pre-let or under offer. So there's a fairly small amount of space being delivered speculatively. We've pulled out a couple of those buildings that will complete in the next year or two. Paddington Square, we've discussed, pretty much all done, hopefully by the end of this quarter anyway. The Lantern, Lazari's building, which is due to PC at the end of the quarter. Of that 140,000 square feet, only 50,000 square foot is available. Space House and the Earnshaw, 2 big Covent Garden schemes, which are just kicking off their marketing campaigns. Fantastic quality of real estate and expected to go well, and some active conversations there. Nova East, the final piece of the Nova puzzle for Landsec down in Victoria. Smaller floor plates are not your obvious early pre-let story, but one that's likely to gain momentum as you get close to PC. And then lastly, 90 Longacre, unusual scale for that central Covent Garden location, went on site at the end of last year and targeting a whole or substantial part pre-let. So when you look at the demand, you look at the supply, and you look at that focus on best quality space, and it starts to underpin where we think rents are going as a house, which is significant rental growth over the course of this year and beyond, and a continued widening of the gap of the best and the rest, which I think will be positive for those who have that pipeline development stock. So just to summarise, West End had a great year and kicked back faster than the city. When you also look at the amount of space that's under offer, we think that momentum will continue into the first half of this year and beyond. Vacancy above trend but falling, and will continue to fall as people get back to the office and reoccupy their spaces and focus on the new best quality kit coming through. And that leads to this pre-let market being a dominant trend that we've seen, particularly as those net zero carbon ambitions and targets being set quite vocally by people needs to be met quite often in the knowledge-based economy through the real estate they occupy. And lastly, that is a positive story for rents, where we expect to see continued growth over the course of this year and beyond. Thank you very much.
Great, thank you, Chris. Over to you, Dan.
Thanks, Chris. Hopefully someone will share the slides. Here we are. West End's clearly picking up. Looking really good, Chris. Very positive, and really it's for me to talk about the city and reflect on where we are at the moment and where we're going. I mean, what is fair to say is there are so many themes that are covered in the city that mirror the West End. So a number of those have been picked up, and I don't want to repeat. But what I would say is that occupiers are definitely seeing London as one market more than ever. And therefore we talk about West End and the city, but so many of those occupiers that Chris put up and then I'll put up shortly really see it as one market. And so Chris and I and other agents see each other a great deal more of each other than maybe we have done before. So but I'll give you a flavour of the trajectory of the recovery and how it's presenting itself, and it's definitely quicker in some areas than others. If you just go back a slide, that would be great. Firstly, and the point is that the recovery is continuing generally broadly, with city quarterly take up highest level since pre-COVID. Availability has increased slightly, up by 6% on the quarter, but still well below GFC levels or anything approaching them. The under construction speculatively is above the long-term average. However, all the completions are due in most of them in the next 18 to 24 months. And finally, on the capital market side, the final bubble there, investments continuing to rebound quickly with a great deal of depth, and over 40 billion of capital chasing what London has to offer and yields coming in. If we go on to the next slide, the take up, you can see that the bar chart at the top, they're running in quarters, and you can see the trend since 2017. You can see how it dipped very significantly during the 2020s, as you'd expect, but a pretty smooth and a pretty sudden uptick in Q4 2021, really reflecting the confidence that returned last summer as we returned to some kind of normality. In fact, Q4 was the fourth consecutive take-up of increased take-up, and take-up in 2021 increased by 50% compared to levels recorded in 2020, so 100% compared to levels seen in 2020. The recovery is also seen across the whole of London, and Chris has talked about it, but as a whole, where take-up actually stood at 3.25 million square feet. Again, the first quarter where it's been above average since 2019. If we look at the take-up by sector, Q4 2021 take-up was dominated. If we just go back, sorry, back one. Okay, go on to the next slide, sorry. In terms of the take-up, you can see the chart there sitting against availability. You can see the two lines actually converging and availability and take-up matching each other, which is a good sign. If we go on to the next slide. In terms of the deals, note back, please. In terms of the deals, we've put up a selection of deals there, and there are a broad variety. The reason we've done that is that they show different things. So 1 and 2 Broadgate there, transaction closed in the last quarter of last year by British Land to Allen and Overy, again moving because they want to attract more talent, attract and retain their talent. To give you an idea of how far ahead occupiers are moving, their lease event is 2027 in 10 Bishop Square, so moving a long time ahead of expiry. Bloom, a fast, quick growing TMT firm, looking to move to Farringdon, moving from the West End due to talent. Again, a lot of their staff being based further east, and a lack of new stock in their current submarket. 22 Bishopsgate, looking at the Apple and the William Blair deals. Phenomenal for the city to be attracting the likes of Apple, taking a big chunk there and then taking more space, as well as the space they've taken in Canary Wharf. And then William Blair, financial firm, pre-COVID were half that size, had a tremendous COVID, as it were, and their investment or their wealth management arm grew, as well as them wanting more spaced out offices. So again, a success story there. And then 2 deals in duo, signing at the end of the quarter, ABRDN and Cognizant, both wanting to significantly upgrade their existing offices and go to best in class refurbishments. If we just stick on to the next slide. The under offers just over 3 million square feet across London at the moment, of which about just under 1.7 million square feet in the city. Again, big chunky deals making up quite a big chunk of that in terms of the likes of Kirkland and Ellis and the likes of Hogan Lovells, both moving forward and going through the gears. And actually the under offers, as Chris mentioned, is actually a very good sign of where we're going rather than where we've been. So it's good to look forward. And that kind of points us towards where we are. If we have a look at the supply, availability, as you can see, it's fluctuated more than the West End, and it actually increased 10% between the first and second quarters before stabilising during the second half of the year. Large development completions in the second half of the year included Brookfield's The Gilbert on the south side of Finsbury Square, about 140,000 square feet, and CIT's Hilo, which I was in earlier this week, and the views there are unbelievable, just near Finsbury, just to the northwest of Finsbury Square. They both completed, as I say, at the end of the quarter. The vacancy rate rose from 6.6% to 7.5% during Q4. Again, a bit of context. Pre-pandemic, it was running at about 5.7%. So it's notched up by a couple of percentage points, which, again, when you look at it holistically, one would have anticipated it moving up significantly more than that if we were sat here 18 months ago. So relative decent performance. In terms of the development pipeline, moving on. People like pictures of buildings. I think this helps sort of articulate where we are. We just picked 7 schemes here that are currently under construction. And you can see they're all of varying sizes. We've listed the remaining amount of space in each of these schemes. The likes of Sancroft, which Shimau are developing, just on the west side of the city. One Crown Place, Alloy MTD developing residential there, but about 110,000 feet there. Helical's 33 Charterhouse, due for completion October this year. Native Lands Arbor, just under 200,000 square feet remaining in the top right picture. MEC and Stanhope's 8 Bishopsgate, just over 500,000 square feet, and Stanzas have got 317,000 square feet remaining. This looks like an awful lot of space coming through, but the demand is absolutely focused at the moment on best-in-class buildings. And that's why this might look like a lot of space coming through, but the relativity of it is that we believe that much of this space will be acquired ahead of completion of these buildings. In total, if you just skip on to the next slide. Yeah, so there's about 5.6 million square feet under construction speculatively in the city at the moment. But about 28% of that is pre-let, and about a further 600,000 square feet has been pre-let off plan. The bulk of the deliveries, looking at the red bars, are being delivered this year and next year, and some in 24. As I say, that pipeline is relatively constrained, but by comparison with the long-term average new and refurbishment take-up figures, which you can see with the blue line there. Moving on to the active requirements out there. There we are. This again just gives you a flavour. Chris touched on a few, and funnily enough, 1 or 2 of those are looking cityway as well. And likewise, these occupiers are also fleet of foot. There are some big names there, the likes of Macquarie, Clifford Chance, TikTok, Standard Chartered, all active, all apart from TikTok, all traditional city occupiers. who have actually made up much of the demand. Again, mirroring what Chris said for the West End, we haven't had those mega tech occupiers taking lots of space, but we believe they're coming back to the market now. What we found is their headcount is increasing significantly, but that hasn't come into office requirements yet, or turned into office requirements yet. When it does, then when people actually return to the office. The other point here is the ESG agenda is very significant, very real for all of these occupiers, and that is a theme which is mirrored in the city as much as it is in the West End. Okay, I kind of feels like on the rents we've already touched on these. I think they're just coming through. I don't know whether they're through on people's slides. No, here we are. You can see there they have they've flatlined a lot, £70 a foot, and went up to £72.50. We slightly differ to the CBRE figures that were put up earlier by Alexander, but the city rents have actually grown from £70 to £75 a foot in our view in the last 9 months, and actually are higher now than they were, as you can see, pre-COVID. So that is a reflection of the occupiers' real laser-like focus on getting the best space and being prepared to pay for it. And that's best in terms of quality, that's best in terms of sustainability, and the best for their staff. So a positive picture to paint there, and plenty of rental growth forecasts as well, I should add. Moving on to the next slide. City investment turnover. This isn't my area of speciality either, but I'm going to tackle it for a couple of minutes. Investment turnover in Q4 total just over 2 billion. It's exactly pretty much mirrors where we were in Q3. And yields in the city have moved from 4% to 3.75% and continue to be under downwards pressure for the best-in-class stock. If we go on to the next slide, you'll see overseas acquisitions or overseas purchases dominated the transactions this quarter and accounted for 64% of all deals by price, and North America making up a pretty significant chunk of that in the green. What I've done then is put up 3 slides which reflect 3 investment deals, all different in their nature, but they reflect an owner-occupier, they reflect a development site, and they reflect a up and let standing building. The first one, sold by DWS, this was a occupier currently in the building deciding to purchase and trump other external purchasers. Achieved in net initial yield of 4.5%, over £1,000 a foot, and as I say, acquired by Omnicom, who are actually in the building with a WALT of 6 years, but now obviously own it, so can occupy at leisure. The next slide is an example of how hot the development market is at the moment. The freehold of this completed, it's just over 700,000 square feet, purchased by MPS and Hines in November. Again, £210 million, £290 a foot on the consented scheme. So depth of demand from occupiers in a way, depth of demand from developers for sure. And then the final slide, this is an up and let investment, sub 4%, has been changed hands a couple of times, but you can see absolutely no abating the capital that's chasing this kind of building. WALT of 8 years, sub 4%, impressive figures, and as I say, a great sign of the depth of the market. So in summary, healthy development pipeline to meet the next wave of demand from a very discerning and selective bunch of occupiers. Rental growth for new build for sure, best-in-class refurbs are included within that. Pre-let demand remains healthy, and downwards pressure on yields on well-let investment opportunities, and that's the city. So thank you very much indeed.
Thanks, Dan. That's really interesting. Katy, I think we're over to you.
Great, thank you. You'll be relieved to know I have cut a couple of my slides, so hopefully we can still have time for some questions at the end. Has that worked? Do you see my slides? Great. Okay, so here's the residential slot for you. I know this isn't primarily a residential focused audience, so I'm going to keep it short, but hopefully interesting enough. Different definitions to get your head around. It's not just City and West End. We refer to things in the residential market as prime central London. Those outer prime London areas include slightly more peripheral. They would be Ealing, Wandsworth, Islington, Hampstead, Canary Wharf, those sorts of areas, but still looking at the very sort of top value within those geographical regions. And what we've seen over the last few years has been a number of successive falls in prices, and the main reasons for that were around taxation and Brexit, and the political uncertainty and economic uncertainty associated with those. But we were just starting to see a turning point, what was being referred to at the time as the Boris bounce, given that we had a bit more certainty around Brexit and we had a bit more political certainty around the vote. But then, of course, even just that one quarter of positive territory in terms of price growth before COVID hit. And what we saw then, thinking about central London, was that the place that people wanted to be? No, of course, we saw people moving out of London at that point. They were looking for more space. They were looking for, it was very much those lifestyle drivers, and whether it was a temporary move, and we know for some that was, for others, it was a more permanent move. However, the market is now showing signs of recovery. So we can see that, that actually, we're seeing relatively strong growth in the last couple of quarters. In annual figures, sorry, there. And what we can tell you is that there is a huge difference between houses and flats. So I referred to those lifestyle drivers. People have been wanting to live in houses, key here, with gardens. So, that's not necessarily in central London, but what we have seen is that there has been big demand for that, especially in outer prime London. And so whilst, this may not be a residentially focused audience, hopefully you all live somewhere, and maybe some of the areas on this map might spark a bit of personal interest for you. And it's interesting, I think, at the moment when the market is so, the different areas are outperforming significantly. We can see that the different regions, the areas that have been seeing really strong growth have been those more domestic markets, in particular around Southwest. Canary Wharf has seen, and the sort of north and east markets have seen the lowest growth. The typology of houses versus flats in those particular regions, Canary Wharf is almost 100% flats. I think it is 95% in terms of our index, the stock in our index. And so it helps us just understand a little bit more about those drivers and what we're seeing in terms of demand there. But it is picking up. So the latest annual data is showing slight positive territory there at 0.3%. And we think that this positivity in the market across the board, but being led by prime central London, is going to continue. We are already seeing some really strong interest in prime central London, some of the biggest deals. And in fact, I think we've recorded a record level of over 5 million transactions, the highest number, the quarterly, that we've seen in about 10 years. So there's in the last quarter, there has been a phenomenal amount of big significant deals happening, a lot of international demand returning to London, some looking to commit without actually viewing the property as well, especially in the new build market. So some really positive signs of confidence in London, and we expect that will continue in a very strong way over the course of the next year, and in particular over the next 5 years as well. Slightly more muted growth, a bit of slightly more muted forecast for other prime London, because these are the markets that are a bit more mortgage reliant, and obviously interest rates are on the up. They have now turned, and actually these are the markets that are going to be a bit more susceptible to that. The other key here is that prime central London market hasn't really ever recovered. It's seen successive tax changes, and we're not expecting a return to the situation, but those tax changes are here to stay. We are in a different tax environment, and but we do think that because the market hasn't recovered, it has still seen those significant falls from that peak, that previous peak. We think that there is more growth to come over the next 5 years. And then just final slide from me, just to touch on some of the trends. And actually, it was really reassuring to hear that these are all being mirrored, I think, probably in the office markets. Clearly, location and travel, people are now reprioritizing being close to work. We survey our buyers about their priorities when looking for a home, and actually, that proximity to transport became slightly less important when you're in lockdown. Having a really nice home, immediate environment is the most important. But now we've been through that phase of the return to the office. We've now had a little bit of, staying at home again, but now we're back in the government's advice being back in the office. Great. People are now reprioritizing and realizing that they do need to be near those transport nodes. working from home, it is, sorry, office guys, it is here to stay in terms of people are now, they do still want that home setup in some form, whether it's, even if it's whether it's one day every 2 weeks, it is still going to form a part of their mentality for what they think about when they want, what they want from their home. And I think also that priorities are within the home or within the sort of immediate area. It is around, what amenities, and actually that came up, didn't it, Chris, on your sort of priorities and what people want from their workplace. They do want to be, they want to have the, proximity to somewhere to exercise, and those kind of things do play an important role. And then, of course, sustainability. And we know that this is really important to buyers. It's only going to become more important. It's there's going to be regulation from the government coming down and affecting us at every stage. So any property developer or buyer will be needing to think about these, all of these points. And final point for me, I would urge people to think about the S in ESG as much as the E, because it's really, really important. And this comes across in the workplace as well as the home, and just the way that people feel about community and the interaction with community, and how actually the built environment can facilitate more of that. So that's all from me. Thank you.
Thank you so much, Katie. So we have some time for some very quick questions. I guess if we could start with one of the questions we received. Are there any other post-COVID trends that you would identify for the next 5 years? I think this is one for all of you, but if we could start with Dan in the city market.
Post-COVID trends, I guess that they're still shaking out, and until occupiers all return to the office, from a purely statistical point of view, it's quite difficult to pin down exactly where office demand will go, because, as I say, so many occupiers we talk to and our occupier teams talk to. Certainly during the course of this year, there was just a bit of confidence building up ahead of Christmas, and then Omicron struck, and then subsequent to that, I would say that there has been again, the office requirements, these occupiers will move, but at the moment they're just reflecting on what their headcount is. So in terms of pure headcount and take up, I think we still have an amount to go and an amount to learn. I think the way buildings are designed and I think the way they are built has changed, and I think occupiers generally want more space, less crammed in, fresher air, more of it, better working environment, much better service buildings, and actually they have to attract people from their homes, which is Katie's world, into the office, and that used to be a sort of said 12, a couple of years ago, you'd say that as in gestury, but now it is very serious, and it's a war for where people are going to work, and people tend to do their best work when they, when they're most comfortable, and they feel comfortable and confident in their environment. I think where developers can do that is the biggest change we've seen. So developers building better buildings, more appropriate.
Okay, thanks, Dan. Would you mirror that, Chris, for the West End?
Yeah, I think that's right. I think a lot of the trends we're seeing now, they were here pre-COVID. They've just accelerated and become increasingly important. But a lot of it's around choice. It's giving people the choice to work in different ways and in different locations. We've seen that rise in third spaces. I think when you look at the common themes of the buildings that outperform, it's the ones which provide that highly generous proportion of communal space. So whether it's activated lobby and reception areas, communal roof terraces, basement facilities that go beyond somewhere to drop your bike and have a shower. I think that is what we're going to see more of, and we know that one of the reasons people go to the office is to learn, to socialize, to collaborate, to have fun. So that ground floor plane, and that touched on the retail market, is incredibly important, and it's the spaces within the building but also the spaces between them. And I think our local authorities have a lot of responsibility there to help create the environments that people want to go into and enjoy.
Okay. What trends would you see, Katie, in the residential sector?
Yeah, so I would actually, just to pick up on that, I would echo everything that Dan and Chris have said about that for commercial buildings, but also say that that is just as relevant for residential buildings. And just to pick up on my final point around the environment and thinking about, or ESG and thinking about the S, loneliness, you know, in the workplace or at home, in your personal lives, if you can sort of think about this in terms of the design, whether it's the, you know, in a lobby, having space, having breakout spaces, or having places that you can meet, maybe having a, you know, a sculpture or some sort of meeting focal point, you know, discussion point, you know, because everyone's, you know, a bit awkward in social, so, you know, you're hanging around waiting for someone to spark up a conversation with a neighbor is, you know, sometimes quite tricky. So actually, what can developers do to enable and help facilitate that, and thinking about the spaces that they provide?
Thanks, Katy. And Alex, from a kind of a global economic point of view, what do you see coming down the track?
Well, I think, you know, it's very interesting, isn't it? Because the, you know, once again, the sort of the death of central London in particular seems to have been prematurely announced. And, you know, London has been through many changes, many big traumas over the many years, and yet it's bigger and arguably better than at any point in its history. I mean, I think what is fascinating about the analysis from the market experts is and you know, this is a theme to be explored in the future maybe, is the extent to which central London is a bit like Heathrow Airport. It's the most attractive destination if you're running an airline or running a business for many players, but they've been prevented from accessing it because of lack of suitable space, of congestion in airport terms, and also cost. Now, as cost pressures have eased a bit, but even in the secondary markets and non-prime, that's kind of allowing companies who've wanted to be in central London, because they recognise that it gives them competitive advantage in the fight for talent and all the rest of it. It's allowed them to move in. So the people who should perhaps be worried are the government. Why? Because this means that there will be pull through from less attractive locations on the periphery of cities and indeed elsewhere. And those areas are the ones that may well struggle. So, you know, in a way, central London's capacity to respond to the needs and requirements of a broader, more complex range of office occupiers, that as we touched on, the fintech companies, the TikToks and all the rest of it, is a very, very interesting development here. And, you know, kind of gives us confidence that from an investment point of view, people will see central London office as safe as houses.
Okay. Thanks for that, Alex. We've got time, I think, just for two very, very quick questions. This one's for Dan. You talked about how investors and occupiers are starting to view London as a single tier market. Interested to get your take on what is driving that, bearing in mind city rents have over time been running at circa 50% of West End rents.
I think they are very slowly converging. I don't think they're going to converge anytime soon. I think, you know, the likes of Mayfair, I think for some people West End is West End, and that will always, you know, because there's smaller buildings there, they haven't got the scale necessarily. But increasingly, and we're seeing it, firstly it happened in Farringdon, where rents are getting up 90 to 100 pounds a foot now, which previously completely unheard of levels, and that is bleeding east for sure. And landlords, certainly in city now, are increasingly having the resolve to, you know, build brilliant buildings. They've always done that, but actually hold out and stand firm and say, well, this is worth this, and we're gonna push for those rents. So I'd say we're making progress. We've never seen so many deals in the £80 plus mark in the city. We're now seeing on towers and buildings with terraces, we're seeing them pretty regularly now. So I would say that it's getting closer, but that you're quite right to point it out. It is definitely there, but occupiers, as I say, look across London now, and they're less siloed than they used to be. And as landlords advisors, we have to do likewise.
And I think Crossrail will be, you know, as an infrastructure project, helps that story. If you take out Mayfair and St James's and you look at King's Cross, Regent's Place, Euston, Paddington, Victoria, you know, all of those markets are now a very similar rental tone to the city. It's only really Soho, Fitzrovia, Covent Garden, Mayfair, St James's, which trade at a premium. And increasingly you see those shortlisted properties encompassing the Crossrail route, from Paddington to Tottenham Court Road to Liverpool Street. So we're seeing more and more of that, and it is the quality of the product that will drive the decision as much as the quality of the micro location.
Okay, thanks, Chris. Just conscious of time, so very final question. I think it's probably one for both Chris and Dan. Obviously, there's been a bit of a focus on prime rents and the requirements of larger occupiers. With the sub 10K market, what is perhaps the best barometer of sentiment? So, Chris, do you want to kick off on that one, or Dan?
Yeah, I'm happy to start, Dan, if that's okay. I think that's probably where you can see the difference between the West End and the City during the course of last year. It was big long-term pre-lets that really drove City, whereas you had a slightly more normalised, smaller deal flow in the West End, which is typical of the respective sort of component size of businesses in those two markets. And also, and this is a personal view rather than maybe a house one, but I think in the West End, those smaller businesses have probably encouraged their staff back a bit more quickly than the corporates, who tend to be a bit more sensitive and aware of the wider pressures from government. So when you overlay then all the retail in the West End and everything else, you start to see that quicker rebound in activity than you have done as you look from the West to the City and then on to Canary.
I'll just add to that, apologies for any background noise. I think the only thing I would add to that is that the bigger companies tend to have better balance sheets, maybe, and they're able to sort of take longer view decisions, which is why that market's carried on. I think smaller, relatively smaller companies, maybe 30, 40, 50 person companies, it's a massive generalization, but maybe haven't had that balance sheet depth and therefore are more reluctant to commit to big rent rolls on 5-10 year terms. And so where I would say that's the reason that market has been slightly slower than the bigger end, and that's the reason we probably talked about it more today. It is that end of the market that's driving the rents, not the smaller end.
Right. Well, thank you so much, Dan. I think we've slightly overrun, so thank you for your time this morning, everyone, and a big thank you to our panelists, Alexander and Dan, Katy and Chris Valentine. Thank you again, and have a good rest of your morning.